Welcome to an update for Order 33. This is Dr. Lawrence Jones from FARME Institute, and I'm recording this very specifically for Nobis Agri Science, who has been a great partner here. All right, so I'm going to cover three things in this podcast, which was similar to last month, but I'm going to look at the Order 33 prices, and I'm going to spend probably more time on the federal milk marketing order proposals that are due to come out here soon, and the state of the milk market. So we'll start with the Order 33 prices. And your statistical uniform price for November was $21.55. And if you look historically, that's actually a fairly good price. It was only here in 2022 that we were higher than that. We'll look at how this November Class 3 contract came in. And it came in 25 cents higher than it was 6 months out. So it was very little carry in the industry. But look at this, we could have locked this in at 2050, somewhere in there. And one of the comments I make to dairymen is when you see this kind of a rally, you ought to be selling into it because you always have milk to sell. And now that gets very difficult and you got to have a lot of courage to kind of hold on to that. But had you done that and sold, all the way up into this rally, you'd be looking pretty good right now. So as I said, there was very little carry in the market. We're down to close to zero. For a long time, it was a bear market. Anytime we could sell milk 6 months out, it was a good thing. And the emotion, which is basically this piece here, which is how it's coming into glide path, was almost back to normal. And if we look out for the next year, more or less, this is the real-time Class 3, Class 4. As I say, real-time, it came off the CME just a minute ago. Class 4 is higher than Class 3, all the way through, and in fact the difference is $1.64 if you look at all of them, and this is the spread between the two of them. With all of this, we can actually calculate, what does 2025 look like. So first off, 2024 is going to come in pretty close to $1.76 above the previous year, and again, we'd been talking about $1.50, $1.70 most of the year, and so that's going to come in about where we thought it would. Right now, 2025 is looking at about a 20-cent increase over this year. We'll have to see what happens to these future contracts. There's a lot of things going on in the industry right now that could change that. So for your particular order, you were depooling Class 3 for the last couple months. You came back in. Now you're at 22 million pounds a day, and that's kind of where you've been hanging out here. The difference between this 19 and this 22 is that new cheese plant. And you should have been depooling Class 4, not Class 3, with the difference in prices there. However, you didn't depool anything different in Class 4 over the last couple months. Now, I expect this is to fall off pretty significantly here as Class 4 really takes an advantage over Class 3. I think one of the big stories in the industry right now is the components, because this has just continued to gone up. If you look at your fat test, you're at 429 in November, you're 422 a year ago, and it came up all the time in November, but those are significant numbers. So what that means is as we make less milk, we're actually still making more pounds of fat and protein because of these components are very strong. And we look at your protein numbers, it's harder to change protein. The bottoms have been coming up, as we've said, and you're 334, 331 a year ago, so you're up a little bit. But if we look at, kind of how these tops have flattened out, you've got the highest protein price that you've had, across the last 6 years. All right, I want to spend a little bit of time on these federal milk marketing proposals because a lot of people have spent time on, what is going to happen. What I'm going to kind of look at is who are the winners and the losers, because there's not been enough time spent discussing that. So the manufacturers will get a higher allocation of the milk price, and that's what's called the make allowance. That's the difference between the component prices and the Class 3 and 4 prices, basically what it takes to make cheese, what it takes to make butter. So those increase sometime as much as 25%. So dairy checks will be lower as a result of that. And so the manufacturers were the winners in this, and basically everything else that was done in this federal milk marketing proposal was try to get money back into the dairy checks that the make allowance would be taking out. So one of the things they did is increase the skim components. They took protein up to 3.3, other solids up to 6, and that will result in a higher milk check. So one of the things that I've been tracking is exactly how is this going to look. So this is a little complicated to look at, but the green line is spot plus 40 cents. And my argument is that's where the class 3 more or less comes in. And we can look right now, there's a little bit of a discount. This blue line here is the current trade. And that is what the class 3 futures are on the market. This orange line is the butter, cheese, and whey using the old, so we're going to write old here, formulas. And then this yellowish line is the new formulas. So write new on the yellow. So what's happening is the trade is saying, yes, we're in the old formulas, and then boop, we're going to come down to the new formulas. And right now there's about a $1 haircut between the new formulas and the old formulas. And this includes the make allowance as well as the skim prices for class 3. So the trade is expecting these to be fully implemented by May of 2025. So increasing the skim components is also going to raise class 1 because the skim of 3 and 4 are used to calculate class 1. But we're going to get away from the average plus 74 cents to the higher of. As a result of that, class 1 will come up and consumers will see higher prices. And this is one of the pieces that really frustrates me. I was listening to a dairy economist yesterday, and he just kind of, well, you know, we're in kind of an inelastic thing. We've got kind of a lowering demand curve on class 1, but, you know, we don't think these high prices are going to impact demand at all. And I just put big question marks on that. Because just assuming there's going to be no impact on demand, you know, because you're going to raise the price of class 1, I think is a little bit short-sighted. But the real big winners of this is going to be the orders that have high class 1, and those are 5, 6, and 7 down there in the southeast United States. Your orders are only about 20 to 22% class 1, so you'll gain a little bit, but not nearly as much. So one of the things I've been tracking is what is better, the higher of, which is in blue, or the average plus 74, which is what we've got now. And interesting, for the next 4 months, the average plus 74 may actually be better. And then as class 4 gets significantly over class 3, then the higher of. But I don't think this is a slam dunk in any way, assuming that the average plus 74 was a bad number. The other thing that they did is remove the barrels from the National Dairy Sales Report. In my opinion, the loser will be the dairy industry with less price discovery, because right now we make about 1.3 billion pounds of cheese a month. The typical National Dairy Product Sales Report for a month is only about 50 to 60,000 pounds, and sometimes it's much less than that. So in fact, the amount of cheese that we're sampling for our prices is just a fraction of what is totally made. My opinion is we should have done something to increase price discovery, not decrease it. And this is also not a slam dunk, because if you go back to 2022, 2023, blocks in blue are higher than barrels. And that's what people look at and say, well, blocks are always higher than barrels. You know, barrels are the stepchild. But there have been significant times when barrels have really added to the milk price. And one of the problems that barrels is highly related to Italian type cheeses. So all of a sudden, if we start seeing lots of mozzarella being used, the Italian type demand goes up, then the several cheese plants will switch from barrels to mozzarella, and then barrels will become short and the barrel price runs up. But we won't actually get any advantage of that now because we're only going to be looking at block price. One of the things I put in last month, which I want to just kind of re-highlight, is what kind of protection do you need? And so for this, I wanted to use an extreme example. So this is Florida. This is the federal order number 6. Right now, they're 82% class 1. So to calculate the current class 3 contribution, you take class 3 and then 1/2 of the class 1, because that's the average of the two. So they're at 42% class 3. So right now, whenever they do kind of a protection, they do 40% class 3, 60% class 4 on a like a DRP kind of scenario. But all of a sudden, if class 4 is higher, then the only class 3 remains is what is actually class 3. So they're going to be at 1.5% class 3. So they're going to be looking at doing 100% class 4. And so that is going to kind of change their approach to looking at protection in terms of DRP or other types of protection. So in my opinion, I'm not a big fan of a lot of these changes. I think some of them were short-sighted. So we'll actually see how they play out. I think the industry has no choice but to approve them, or else the federal milk marketing order is dissolved. So again, it's just going to be kind of an interesting scenario for this next year to see if these were good or bad decisions. All right, let's look at the state of the milk market. So right now, there are several things that are impacting the milk market. You know, breeding all these dairy cows to beef has really resulted in much lower slaughter numbers. So we just don't have the replacements. Our latest data for the 7th of December is 55,000, which is a little bit lower than a year ago. But overall, for the rolling 12 months, we've slaughtered 379,000 fewer animals than the previous 12 months. So this herd just should be exploding, but in fact, we've only come up by about 20,000 cows. With this, we can kind of calculate that we've got replacements probably about 0.72 per cow. And as I showed you last time, you know, when we have that kind of low replacement rate, our turnover rate is going to have to end up with higher lactation numbers. So we're going to be, you know, up almost 0.5 to 0.7 average lactation numbers. Dairy cows are actually up 20,000 from a year ago. As I say, we called a whole lot fewer cows, so this should have been just exploding, but it wasn't. We had this downturn, and then now we're kind of leveling out. Significantly lower than we had in middle of 21. Higher than we had when we had good prices in 2019, but a little bit lower than we had lower prices in 2018. The other thing is this bird flu in California. How long, how significant, but year over year, California was down 9.2%, and that just kind of sent shock waves through the industry. There are about 600 herds that actually have bird flu at the beginning of December, but again, as many of you know, that a lot of times this kind of runs its course, and within 3 or 4 weeks, you're back to at least some level of normalcy. But the milk production, again, was down. The headline was California was down 9.2%. So I kind of started digging into, you know, what happened to the overall production. And it turns out we were down about 5 million pounds below expectation, and the difference in California was 4.3 million pounds. So basically all of what the milk production was down in November can be attributed to California. The other are these new plants, the Hilmar plants being watched by everybody. They've had some growing pains, some startup pains. They're not making quite as much cheese as they thought they would. So that's kind of put a damper on some of the fresh cheese availability. We've also got the Great Lakes plant that's coming on. We got a mozzarella plant. Again, the mozzarella plant is going to help drive up barrel prices, but we're not going to have that. Now, the one that I'm kind of interested in is how it's going to play out are all these class 1 plants, because we've got 2 major Walmart plants coming. Then we've got a Fairlife plant up here in New York, another extended shelf life plant, and then another fluid plant here in California. And because those are always the higher price, they're going to be pulling milk from everything else. But again, we got to get the consumer to consume that milk. The Fairlife one I'm not worried about, because right now Fairlife seems to be just kind of flying off of the shelf, so that's probably going to be a good thing. But some of these other plants, we'll see if they can keep fluid price up. Overall, daily production has been declining. We were on this significant uptrend, and then at the end of 2023 and 2024, we've clearly started coming down in production. And this is milk per cow, kind of the same sort of thing. This drop here has kind of contributed to California being down. But again, why would you be making a lot of milk per cow when we have just tremendous components? And in fact, I think the egg prices value will come in about 4.38, which is up like 12 ticks from last month. And if we do that, the month over month fat production, given the milk that we had, is going to be up about 1.4. So even though we're losing milk production with these high components, we're still getting the amount of components that we need. Fat percentages have just been growing something significant, and I expect this November one to be up here at 4.38. The other thing that's impacting the industry right now is exports. And so we got the last global dairy trade here a couple days ago. It was down, but that was whole milk powder. And so I like to compare how the last global dairy trade is compared to our latest spot market. And this was actually yesterday. So let's see how these compare. So right now, butter is higher on the world market. So it seems like we should be exporting a little bit of butter. Cheddar is only 27 cents, and sometimes I figure it takes closer to 30 cents to get it offshore. Non-fat dry milk is just way over top of the global price on the spot market. So non-fat dry milk is driven largely by the lack of production in California and a pretty high demand in the US right now. To look at a bigger picture of this, I always plot out the different cheese prices. So green is global dairy trade. We were at 213. The last National Dairy Sales Report, we were at $1.92. That was November now. Things have changed just a little bit here in December, as we just saw. And then the spot market was $1.82. These black dots are whenever we have enough of a difference to be exporting. So we should have exported some in November. Now, whether we can continue that into December is yet to be determined. So overall, cheese stocks have been coming down. If we look at the long-term trend, it was clearly up, and the 2022 number may be on that long-term trend, but we are way off of that now. And we're down to 1.3 and change billion pounds on stocks. We were clear up to 1.5, which was entirely too much. And if you look at the forward curve, maybe we should have been, putting cheese into cold storage in November. But if there's a 6-cent cost of putting it in and pulling it out, we're not going to be putting cheese in cold storage here unless we get a better forward curve on the cheese price starting in January. American stocks have also been coming down. They followed exactly the same trend. And when I was looking at the data, you say, well, maybe they're coming down a little bit faster than everything else, but they're still 57% of the cold storage. So, they're coming down a little bit faster, but they've got, a higher base number to start with. But again, about 57% of total stocks are American stocks. We start looking at disappearance. The data is a little old because we haven't got the dairy products report yet, but the blue line is above the black line, which tells us that we've been moving cheese away much faster than we've been making it. Now that's slowly changing a little bit because our rolling disappearance is about 39,329 pounds a day. But in October, we made 39,550,000. So again, we were about right on. But this is like a rolling herd average. It takes a while to come back together, but demand has been very good. Look at what's going on in the spot market that controls kind of the day-to-day activity. So this is our spot cheese. We'd had a support and resistance starting back here in June. That seemed fairly good, but then we ran up here in November, and then we came back into that channel. Then we fell down here in November, and we seem to be building a new channel here. We're in a little bit of a downward trend right now. I think we've kind of topped out. The commodity that has just really taken off is whey. So to orient you to this graph, the red dots are the spot market with a 4-week lag. I use a different lag with each of the components, and again, that's just kind of been built in history over time. So again, the National Dairy Sales Report was coming in fairly close, and all of a sudden, whey took off. And what we're trying to figure out is it going to follow clear up to where this was at 79, or is the National Dairy Sales Report going to kind of trim this off down, in the 72 or even 69 kind of number? But whey has been very strong. Butter prices have been falling off. This is the same type of graph. It was clear up here at 273. The last one is 256, and it seems to be kind of coming in here at that 256 kind of number. Now, non-fat dry milk has just really blasted off of the global dairy trade. Global dairy trade has been trending down, and we've just been holding this trend here. So this is just phenomenally strong, and it's holding class 4 prices up. We did just get the advanced prices for January. The base class one was $23.38, and this has been coming down. We've shaved about $3 off of that, and the Michigan price should be right around $22.37 for class 1 in January. Another major component of the milk market are the grains, and so I'm going to kind of show you the corn rolling trend. Back here in August, September, I was getting some calls and said, hey, what do you think about corn prices? And I said, boy, at 140 a ton, it just seems like you ought to be locking in your corn for the next year. And that turned out to be kind of a good observation. And I don't want to call them recommendations, because I never tell anybody exactly what to do. But now this is trending up, and we're pushing that 160 number. Now, these are Friday, last week closes, but that corn number is definitely coming up. We track this PE index, which is 8 pounds of cornmeal, 8 pounds of soybean meal, and anytime that's under $2, the feed cost is very favorable. Just finish up here with a little bit on weather. I follow Eric Snodgrass pretty religiously, and he's just kind of concerned about this drought in here. And if we look at Michigan, northern Indiana, northwestern Ohio, this area is fairly dry. And we look at the outlook here for the next 6 to 10 days. We do have some precipitation coming in on those atmospheric rivers in the northwest. We've opened up a little bit of the Gulf moisture coming up, but we're going to have significantly above normal temperatures, covering most of Michigan and Indiana and northwestern Ohio again. And I know that follows on the heels of some pretty cold weather that we had. We stayed above zero, but we were about 2 degrees here in upstate New York. All right, that's what I have for you this month. Appreciate your time. I will get you another report next month. Apologize for this coming out kind of in the middle of the holidays, but that's how the timing all worked out.